You are listening to The Vocal Technologist. Spoken tech for your ears.
Imagine an AI program just going out and opening its own bank account.
Yeah, and then paying for its own research data.
Exactly. Trading stocks while you sleep, all using digital dollars. I mean, no human intervention, no business hours at all. Today, that isn't sci-fi. It's happening right now.
It really sounds like something straight out of a cyberpunk novel, doesn't it? But it's actually the new reality of global finance.
You know, when we usually think about the global financial system, we tend to picture it like this massive antique grandfather clock.
Right, very intricate.
Yeah, it's imposing. It has all these discrete gears, banks, clearinghouses, brokers, and it requires constant human winding. And crucially, it just stops ticking on Friday afternoon.
Which is incredibly inefficient when you think about it. I mean, it's entirely mechanical, right? It's completely bound by legacy business hours and, well, physical geography.
But looking at this massive stack of crypto and financial newsletters we've gathered from early June 2026, that antique clock is just being dismantled from the inside out.
It really is.
We are watching the financial system turn into something more like a biological organism. A 24/7, borderless, and increasingly AI-driven money loop. So, for you, the ever-curious learner joining us for this deep dive, our mission today is to map out this exact rewiring.
Because it affects everything.
Exactly. Because whether you're prepping for a board meeting or just trying to, understand the future of your own bank account, the architecture of money has permanently changed. Okay, Let's unpack this, because we're looking at a fundamental shift in how the world operates.
I think the best place to start is right at the boundary where traditional finance, or TradFi, meets blockchain architecture. Because honestly, that boundary is basically disappearing, and you see it clearest in the plumbing of the stock market. Take Paxos Security Settlement Company. They are now the first blockchain firm fully authorized by the SEC to clear and settle U.S. equities on-chain. And they're doing this alongside legacy giants like the DTCC.
I want to pause there for a second, because clearing and settling, that sounds like deep Wall Street jargon. Why should you or the average person care if Paxos settles a stock on a blockchain?
Well, it really comes down to trapped money. The legacy standard for the stock market was recently updated to what's called T+1. That means trade date plus 1 day.
Right.
So when you buy a stock, the actual transfer of ownership and the funds, it doesn't finalize until the next business day. And during that gap, clearinghouses demand these massive amounts of margin collateral from brokers to ensure nobody defaults.
Wow.
Yeah, we're talking billions of dollars locked up, just sitting there doing absolutely nothing just to cover the risk of that time delay.
So basically, because the grandfather clock ticks so slowly, everyone has to leave giant piles of cash on the table as insurance.
Precisely. But when Paxos settles eligible securities same day, or, near instantaneously on a blockchain, that counterparty risk drops to almost zero.
Oh, because the delay is gone.
Exactly. You don't need a massive insurance buffer if the trade settles in 2 seconds. They are freeing up untold amounts of locked capital for institutional players.
That makes total sense. And, it's not just traditional stocks getting this upgrade. We're seeing intense derivatives move on-chain for U.S. traders, too.
Yeah, the perps.
Right. The CFTC just approved onshore regulated perpetual futures. Kalshi is offering no expiry crypto perps, and Coinbase Financial Markets is providing access via Bermuda.
We should probably define perpetual futures because they are a cornerstone of crypto that's really bleeding into traditional markets right now.
Please do.
So, a standard futures contract is an agreement to buy or sell an asset at a specific price on a specific date in the future. But a perpetual future, or a perp, never expires. It allows traders to get leveraged exposure to an asset's price movement indefinitely.
Right, and historically you had to go to these unregulated offshore exchanges to trade them.
Exactly, which is why the CFTC chairman explicitly noted that this onshore approval is a foundational price discovery tool. It's a huge deal.
And Coinbase is taking it even further, right? They launched a pre-IPO perpetual future for SpaceX. This is a contract tracking SpaceX's private valuation, targeting a $75 billion IPO at $135 a share.
And you can trade it 24/7 with up to 5 times leverage.
Right. But I want to pivot to something Binance is doing, because I'm actually a bit confused, maybe slightly skeptical about their new product.
Oh, what's the sticking point for you?
Well, Binance just added over 7,000 U.S. stocks for non-U.S. users. 0 commissions, fractional shares funded by digital dollars like USDC.
Yeah, utilizing Nest trading and Alpaca.
Right. The underlying brokerage is just a white label setup. But the real story is their self-issued tokenized equities, which they call B stocks, on the BNB chain. So here's my question. If I hold a B stock, do I actually own a piece of the company, or am I just buying like a ghost token with price exposure?
I see where you're going.
Because, a few years ago, a DeFi platform called Ondo tried launching tokenized stocks, and those tokens came with absolutely zero voting rights.
You are right to be skeptical, because it is exactly like the Ondo situation. What's fascinating here is that the infrastructure itself is becoming the actual product. A B stock gives you price exposure, sure, but no shareholder rights. It's a synthetic derivative, not true equity ownership.
So I don't get to, vote in the shareholder meeting. I just own a tracker.
Correct, but the trade-off is velocity. Because it's a token, it settles instantly, and you can plug it into decentralized finance applications. You can use it as collateral at 3 a.m. on a Sunday.
Right.
But you are highlighting a real tension here. 24/7 trading fits crypto perfectly, but the CFTC recently issued an advisory warning that 24/7 trading might actually be incredibly dangerous for traditional assets, specifically things like agricultural derivatives.
Wait, really? Why would trading a SpaceX token 24/7 be fine, but trading a corn future on a Sunday be dangerous?
It comes down to liquidity. If you open trading on crop futures at 3 a.m. on a Sunday, the big institutional buyers and sellers, they just aren't at their desks. The market is incredibly thin.
Oh, I see.
And that leads to widened bid-ask spreads, meaning worse prices, and a massive increase in manipulation risk. A single large order could artificially crash the price of wheat while the rest of the world is literally sleeping. The biological 24/7 organism model works for digital native assets, but corn and wheat still grow in a physical world tied to solar cycles and human labor.
Right, you can't tokenize a physical harvest. But for assets that are purely digital, once you can trade anything 24/7, you desperately need a currency that settles 24/7.
Exactly.
Imagine trying to send an urgent email, but your internet provider says, sorry, the post office is closed for the weekend.
Right.
That's literally how traditional banking works, and stablecoins are finally fixing it.
Which is exactly why the biggest players in traditional payments are aggressively adopting them now. Mastercard just expanded its on-chain settlement framework to support 24/7 settlement. They are completely bypassing traditional banking hours by using 6 different stablecoins across 8 different networks.
And the banks themselves are pivoting too. I mean, for years, banks viewed stablecoins, these crypto tokens, pegged to the US dollar as a massive threat to their deposits.
Oh, absolutely.
But the June 2026 data shows a total reversal. They're realizing it's an accretive revenue opportunity. Revolut, for instance, is planning to launch a US bank with 0 physical branches, combining FDIC-insured accounts directly with stablecoin services.
The efficiency gains are just too undeniable to ignore at this point. Just look at the foreign exchange data in our sources. If you want to swap 1,000 Brazilian real into another currency using a traditional service like Wise, you suffer from weekend delays, and your money has to bounce through correspondent banking hops.
Right.
That's where banks pass your money along like a bucket brigade, and they take a tiny fee at every single step. But on-chain, an FX swap of 1,000 Brazilian real settles immediately at roughly a 0.8% all-in cost. No bucket brigade, no weekend delays.
And this transition from the bucket brigade to instant digital networks, it has huge geopolitical weight. We're seeing nation-states actively repositioning themselves around this technology. For instance, U.S. Treasury Secretary Scott Bessent, under the Trump administration, officially backed a U.S. strategic Bitcoin reserve.
Yes, and we should be very careful here.
Absolutely. Just to be completely clear for you listening, we are not taking any political sides here. We are not endorsing this political administration or this specific policy. We are strictly impartially reporting the facts contained in our source material regarding how digital assets are being positioned geopolitically.
Exactly. Our job is just to look at the data. And the data shows this executive order establishes a reserve holding roughly 328,372 Bitcoin,
Right.
which is valued around $25 billion. He's also pushing the Clarity Act to finally establish concrete definitions for when a token is a security versus a commodity.
Right. It signals a profound shift in how governments view digital scarcity as a strategic asset. But, while nation states are hoarding Bitcoin, the actual demand signal on the ground for everyday people globally is entirely about utility.
Definitely. Look at India. Their crypto market is ranked first globally in adoption, and it's projected to hit over $14.2 billion by 2034. Coinbase just launched direct Indian rupee rails there.
Wow.
Yeah, meaning retail traders can go straight from their bank accounts to the blockchain, bypassing peer-to-peer middlemen entirely.
But it's not just everyone scrambling to get their hands on digital US dollars, right?
No, and that's a massive shift in the data.
Yeah.
In places like Latin America, the primary demand signal is moving beyond USD dollarization. We're seeing a huge push for local currency stablecoins. People want to swap Brazilian real for Argentine pesos instantly on-chain to conduct cross-border commerce without having to route their money through the US dollar as a middleman.
Okay, let's take a step back for a second and just look at the sheer scale of what we've covered. We have trillions of dollars of traditional stocks, stablecoins, and global foreign exchange all migrating onto these decentralized blockchains.
Trillions.
Right, which means the underlying networks, the blockchains themselves, have suddenly become the most critical financial infrastructure on Earth. Here's where it gets really interesting. Let's look at Ethereum. The data shows Ethereum currently holds roughly $250 billion in settled assets. But it is only protected by $72 billion in staked ETH.
That is a fascinating and frankly potentially dangerous structural imbalance.
Right. For you listening, think about it like this. It's like Ethereum is a massive decentralized bank vault holding $250 billion.
Yeah.
But we are only paying the security guards enough to care about $72 billion. Isn't that an economic mismatch?
It absolutely is. And let's explain how those security guards actually work, because Ethereum doesn't use massive server farms mining for complex equations anymore. It uses a system called proof of stake. To process transactions and secure the network, validators have to lock up or stake their own ETH as collateral. If they try to process a fraudulent transaction, the network slashes their staked ETH. They lose their money.
So the security of the whole network is directly tied to the monetary value of that locked-up collateral.
Exactly. So if an attacker wants to take over the network, they have to buy up a majority of that staked ETH. Which brings us right back to your vault analogy. Analysts have proposed a security cost valuation model arguing that Ethereum should be priced against the total value it secures.
Which makes sense.
Right. Because if a cartel of hackers could theoretically spend just $37 billion, half of the current staked amount, to take over the network and steal $250 billion, you have broken math. It's a profitable, albeit highly illegal, business model.
So to fix the math, the price of the collateral basically has to go up.
Yes. The model suggests that the staked value needs to approximate the secured value. Based on that math, it implies a fair value for ETH of around $6,900, which is dramatically higher than its current spot price, around $2,070. Ethereum isn't just a speculative coin anymore. It's really the Amazon of financial infrastructure.
But, being the settlement layer for global finance puts a massive target on your back.
Yeah.
And not just from traditional hackers trying to buy up staked ETH. The reports detail a terrifying new vector, which is the quantum threat.
Yeah, this is intense.
2 researchers from Eigen Labs recently used swarms of AI agents to replicate 80% of Google's unpublished breakthrough for breaking ECDSA cryptography.
Which, just for context, is the exact cryptography that secures almost every crypto wallet on Earth right now.
Yeah, and I'm not a cryptographer, so explain how a quantum computer breaks this when a normal supercomputer can't.
So ECDSA relies on elliptic curve cryptography. Without getting into the really dense math, it's essentially a very complex puzzle based on prime factorization. For a traditional computer, finding the solution would take millions of years. But a quantum computer doesn't solve puzzles sequentially. It evaluates all possibilities simultaneously.
Wow.
Right. If a quantum computer reaches a certain threshold of power, it solves the elliptic curve instantly. The vault doors just swing wide open.
So how is the industry preventing a massive quantum heist?
Well, the Lean Ethereum team is racing to replace those vulnerable elliptic curves with something called LeanSig. It shifts the security to a hash-based post-quantum scheme using Merkle trees. Unlike elliptic curves, hash functions are like a meat grinder.
A meat grinder.
Yeah, you put data in and you get a random string of characters out. You cannot reverse engineer a hamburger back into a cow no matter how powerful your quantum computer is. Hashes are inherently quantum resistant. But, implementing this is a massive, highly technical overhaul of the engine while the airplane is already flying.
And sometimes the biggest threat to this infrastructure isn't a futuristic quantum computer. Sometimes it's just the traditional legal system colliding head-on with smart contracts. Just look at what happened with Zama and Circle.
This is a perfect example of what happens when legacy laws meet decentralized infrastructure.
A U.S. federal court ordered Circle, the company behind the USDC stablecoin, to freeze $12.6 million tied to a civil lawsuit over a project called Overnight Finance. The problem is, those funds were sitting inside Zama's privacy wrapper.
And we have to understand how a privacy wrapper works. It doesn't just hide your individual balance, it pools everyone's money together into one giant smart contract, mixing it up to obscure who owns what, and then lets users withdraw their portion later. Think of it like a shared safety deposit box for thousands of people.
Right. So when the court ordered Circle to freeze the specific funds of a bad actor, Circle couldn't isolate them. They had to blacklist the entire pooled smart contract. The freeze trapped the funds of every single innocent user who happened to be using that privacy protocol, because it was all commingled liquidity.
Exactly. When you drop a traditional legal freeze onto commingled, decentralized infrastructure, the collateral damage is instantaneous. It highlights a massive friction point.
But when you have these automated privacy protocols and smart contracts executing trades without human permission, you're essentially building a financial system that doesn't require humans to operate it. And that opens the door to something really wild, which is non-human actors. We talked about AI being used to break cryptography, but now AI is getting its own wallet.
Welcome to agentic finance. This is where AI transitions from being a helpful chatbot that, writes emails for you to an autonomous entity with true on-chain financial agency.
Right. The June updates detail an autonomous crypto analyst agent named Hermes. Hermes can execute complex manual research workflows in 10 seconds, down from 3 minutes. But the groundbreaking part is how it pays for its data. It uses something called the Buy 402 agentic wallet.
To Buy 402, yeah.
Hermes can independently pay for his own API access to data services like Nansen or XA. It just pays a few cents per data call. It bypasses human subscription pages entirely.
And think about the mechanics of how that happens, because it's completely impossible in TradFi. If you swipe a Visa card for a 4-cent transaction, the base merchant fee is usually around 30 cents. The business actually loses money.
Which is why everything is a $20 a month subscription now.
Exactly. The legacy system forces us into subscriptions. But an AI equipped with a stablecoin wallet on a high-speed blockchain can stream micropayments of a fraction of a cent, thousands of times a second, with almost zero overhead.
It's a completely new economic model.
Yeah.
Polygon is betting heavily that the next major payment category isn't human-to-human, but agent-to-agent, or A2A. AI agents paying other AI agents for services.
It's wild.
And the capital flowing into this is staggering. The Q2 2026 Agentic Finance Report shows AI vault products accumulating massive total value locked. I mean, Theo Network alone is holding over $400 million. Even TradFi giants like BlackRock with their Aladdin system and JP Morgan and Goldman Sachs, they're launching autonomous trading systems.
The efficiency of an autonomous system that never sleeps and processes microtransactions instantly is just too ruthless for Wall Street to ignore.
But I have to ask, on behalf of you listening, when AI is trading anonymously, how do you know if you're interacting with a groundbreaking A2A economy or just a guy in Texas running a $12.3 million Ponzi scheme? Because the DOJ and the SEC just sued the founder of Privy over a fraud where the promised AI trading bots generating 100% returns literally did not exist. It was totally fabricated.
Well, it's the classic gold rush problem. The scammers always arrive before the regulation, but if we connect this to the bigger picture, you separate the hype from the architecture by looking at the underlying infrastructure. The Privy scam was just a guy making false promises on a centralized database. True agentic finance is verifiable on-chain. We know the shift is real because major institutions are standardizing the plumbing. For example, Coinbase just contributed that exact Buy 402 payment protocol we discussed directly to the Linux Foundation. When the plumbing gets legitimized by major infrastructure players, the shift is legitimate. It moves AI from chatbox novelties to real entities.
So with AI agents trading autonomously and massive institutions settling traditional stocks on blockchains in seconds, what happens to the crypto bros, the wild, mean-driven volatility that originally defined this entire space? Are we finally seeing the dot-com crash of crypto, where the useless speculative stuff dies off, leaving only the actual utility behind?
The data strongly suggests we are in the middle of that exact transition. Look at the market realities in our sources. Bitcoin is losing what analysts call the momentum trade. Even Strategy, the firm famous for endlessly acquiring Bitcoin at any price, just sold Bitcoin for the first time ever. Yeah, they liquidated 32 BTC for $2.5 million just to fund preferred stock dividends. That is a return to traditional corporate finance mechanics.
And we saw Arthur Hayes, a massive figure in crypto trading, liquidate $18 million of speculative altcoins called HYPE and NEAR, literally days after publicly betting 100 grand that HYPE would outperform the market.
Right, there's a massive liquidation cascade that wiped out $714 million across the broader market. But what's crucial isn't what died, it's looking at what survived that wipeout, the networks with demonstrable utility.
Like Noble Mobile acquiring Helium Mobile. Helium has 139,000 actual physical hotspots, providing internet to 2.6 million daily users. That's real-world infrastructure to developing or decentralized physical infrastructure networks. It has staying power because people are actually using it.
Exactly. Variance framework evaluates crypto assets as a store of value, or SOV, and their criteria aren't based on hype or how funny a meme is. They are based on technical durability and censorship resistance rather than just memes.
Meaning the asset actually has to do something durable to be valuable.
Exactly. The era of launching a speculative app built around intellectual gambling is fading. The sources note a massive cultural shift happening right now. There's a toxic culture on crypto Twitter around slow rugs projects that slowly bleed out and fail to retain users, and it's deterring real builders. The market is aggressively demanding utility over speculation.
So what does this all mean for you listening? To summarize this massive journey we've taken you on today, we've watched the financial grandfather clock get dismantled. We are seeing U.S. stocks clear on blockchains in seconds, removing that T+1 trap. We are seeing stablecoins route around traditional banking weekend closures, allowing money to move instantly. We've seen Ethereum transition into a $250 billion global vault, racing to implement hash-based cryptography to outsmart quantum computers. And perhaps most wildly, we've seen AI agents getting their own wallets, streaming micropayments in digital dollars to do research and execute trades.
It is a systemic, permanent rewiring of how value moves across the globe.
And that's why this matters to you. Because whether you are prepping for a meeting or just trying to understand the future of your own bank account, the architecture of money has permanently changed from a closed 9-to-5 system to an opened programmable network.
Which leaves us with a rather profound final thought to mull over.
Let's hear it.
If an AI agent can hold its own money, trade stocks 24/7 without sleeping, and settle cross-border payments instantly, at what point does our global economy stop being a human system and start being an algorithmic ecosystem that we just happen to live inside?
Oh man, the biological organism has a mind of its own now. Thank you so much for joining us on this deep dive. Stay curious, and we'll catch you next time.
Spoken Tech for your ears.